Yeah, I'm losing my
We're talking
edge.
about reducing risk with covered calls. This is something that a lot of people would not expect from a small exchange sponsored show on account of the smalls do not have options quite yet. There's a team of people, Pete included, working on getting options on the smalls on a daily basis. And I hear that that's going pretty well. I kind of duck my head in and then duck out because I do not want to have to deal with what is a very difficult process, I'm sure. But we got good people on it. We'll see those options soon. Very excited. It's really going to be nice. I can't wait for people to see option markets, Pete, on a product that is sized like an ETF, but is going to have the efficiency of options on those big futures contracts. It's going to be a real beautiful market there. People are going to start seeing, okay, I'm selling a call or I'm selling a put for 70, 80, $90, and the buying power is a couple $100, as opposed to, ETF world, it's like, oh, I'm getting 70 or $80, the buying power is $3,000. And then in the futures world, it's like, okay, I got a credit of $1,000 and the buying power is 12,000. And so it's going to be real nice, sized like ETF options, but buying power efficient like those futures options.
I agree with you. No,
all right, let's get into it. He wants to get done with the segment and get out of here so he can eat his steak sandwich.
I was actually feeling bad because my background is my lunch relative to what it should be, which is my cool small exchange background.
Hey, there it is. Wow, look at you troubleshooting midway through the segment. All right, SM75, Pete, well within its range for July at $6.60. And what I did here, quick math aside, is I just calculated for the three smalls products, I calculated a running realized volatility. Then I used that realized volatility on July 1st to calculate an expected range. And everybody knows implied volatility is different than realized volatility. Well, sorry, we don't have implied volatility via options markets that don't exist in the smalls quite yet. So I'm doing the best I can. So 660 in the small stock 75. And this is kind of hurting my feelings a little bit. The fact that the small stock 75 isn't really testing an upside or downside of this range. It's been pretty muted recently, and we've had trouble getting a trade. And I hope this really picks up in the near future.
Yeah. And I think we've talked about, you know what, go through the rest of the phone book of indexes, and you're kind of seeing a little bit of a struggle with that too, except for the five stocks within NASDAQ. So that too changes over time. So let's you know what, I don't think this is this is unique to this product. It really is. You take a look at Russell, S&Ps to the same extent. So, this leadership laggard piece will play out. And we know that this, especially going through our launch in June, July, this is a underlying that has a great propensity to move. It's just giving it the right amount of time.
You're totally right. I totally forgot about S&P 500 even as just an index, because that hasn't really moved. I guess, equities kind of hurting my feelings in general. Even the NASDAQ that's been moving, just hanging in at those highs. And this is the nature of things. You saw all this volatility a few months ago, and now equities are less volatile than some other asset classes like foreign exchange that are picking up. /SFX is actually slightly through what was its expected range to the downside
there
here.
You go. Yeah.
And expanding on it a little bit more today. To the interest of some people, Pete's been short the dollar. He's loved dollar shorts, I think, pretty much all year. But also, and this is why we're talking about reducing risk today, anyone trying to pick up long dollars in this mess, getting hit pretty consistently and now accumulating, a couple $100 in losses as this market has moved outside of its $2.35 expected range to being down about $3 in the month of July.
Right. And, I think, Frankie, you make a good point. It's not the directional fact that, you happen to be right or wrong at this particular moment. The fact is that the dollar is moving outside of that expected range.
Yeah.
It's starting to exhibit behavior that finally gets us. We always talk about inside and outside that cone is is an interesting aspect in terms of trade. Statistically, where do we live within that standard deviation of movement? Where what is good is when the market starts to exhibit behavior
Yeah.
outside of that, and that really speaks to, okay, we're now getting a product with movement that is, it's not the right word, but non-traditional, or what we've been kind of seeing over the last period of time. So this is good. Directionally, you know what? This could be really cheap right now, when we could see corrective bounce of the dollar. We have no idea what tomorrow brings, but I do like the idea that this is starting to exhibit behavior of a better magnitude than we've seen in a long period of time.
No, that's a good point that we haven't really touched on yet today, which is, so this cone represents kind of what's expected, what's normal for these markets. But as active participants in the trading marketplace, you don't really want normal, right?
Wow.
Like if you've passively invested for the last decade or two, and you're just going to continue that for the next couple of decades, you want normal. But when you're looking at markets daily and trying to make money from trading these markets intraday or day to day, you want what is abnormal outside of this cone. So yeah, definitely bringing in some new opportunity. If you wanted abnormal, you came to the right place with precious metals, because this is a market that had an expected range for July of $2.90. It's up more than twice that on where it was at the start of July. Very abnormal movement in precious metals, but and a lot of people jumping into silver, gold,
Right.
small precious metals in here to start trading. And that's why I wanted to turn the conversation to a little bit of risk reduction, because I think looking at charts like this and this here, SFX and SPRE, I think people, when you see abnormal movement, it's probably easier for people to get a handle on what they want to do in the market.
Right.
But executing that, Pete, in a way that's going to be a risk tolerance you're okay with is honestly a bit of an art. And I crunched a bunch of numbers here, because we don't have call options on these three products. But what we do have is a whole ecosystem of other products and options on those other products to do cross product covered calls, which is, a little bit more creative and interesting, a slightly bigger
Absolutely.
ask, but I think it's really worth it. And here you can see what I've done for each of these products, Pete, is use options in their most highly correlated alternatives to cut out about half of the position. So, for example, if I went to SM75 and I wanted to buy SM75, I would use Russell, or you could use S&Ps or Dow, but in this example, using Russell, I need about 3 short deltas in /RTY or 16 short deltas in IWM. And that's going to cut out about half of my exposure in small stock 75 at the point of putting the product, the trade on. And this is all just to slow these markets down a little bit. It might not be very apt for current trading in SM75, but for example, in SPRE, if you wanted to buy precious metals and it's been moving like mad, it's up. This product is up what, $5 or $6 in the last week or so, and you're worried, okay, if I buy it here and it moves lower by $5 or $6, that's $500 or $600.
Right.
What you do is cut that theoretically in half to what would have been a $500 or $600 loss is now maybe a $300 or $400 loss by getting short 2 deltas in GC or 20 deltas in GLD. And same on the flip side. We're talking about covered calls, but this is for all covered positions. If I wanted to get short SPRE, you just got to flip the signage on these. Right. But yeah, this is a nice little.
And it is. And this is a nice way to, you're pulling out the anchor tenant of these diversified indexes. So euro is the largest component of the dollar index, gold the largest component of precious metals. So you're creating a nice cross-product manageable hedge. And all these trades you're putting together, especially in GC, if you're doing it defined risk or using GLD, you're doing it for a very small amount of buying power and getting that exposure. So there's lots of, and I like the fact that you're talking about the idea of managing some of these outlier moves. If you want to either participate in them on a momentum basis or on a reversion basis. These become really interesting ways to, it's never smalls or, it is smalls and this really puts the powers of smalls and. Let's be product indifferent. We always say it. It's so easy to say, I'm product indifferent. I don't care as long as it moves. Well, let's empower ourselves with true the ability to be product indifferent and give ourselves as much edge as possible. So this is a great walkthrough of that through three distinct different types of two different futures exchanges, and then moving into an entirely different asset class.
Yeah, and I think the ETFs will be easier for people to jump on board with because, in GLD, for instance, if I were to sell SPRE, all I would be doing in the GLD options is I would be selling probably like the 30 delta put and then buying the 10 delta put against it.
Right.
And you might look at these futures positions and be like, okay, jerk, how do I get 2 deltas in GC or 3 deltas in RTY? It's actually really easy to get that.
It is.
With those call spreads and put spreads, and you're defining the risk, which says, because the last thing I want, Pete, is to go into SPRE and sell a naked call against my long SPRE in gold because, oh man, like in a matter of minutes, you could be short a ton of gold and your SPRE is not taking out that.
Right. And you look at that, and the greatest telltale is that naked call is going to cost you $7,500. You look at that against the $230 of SPRE margin. That's got to tell you right there something's missized in this trade. So
exactly.
So always build pairs, margin to margin, buying power to buying power. But that ballpark is an important one. If you catch yourself that, wait, this doesn't line up, it probably doesn't. And you're right. The ability to create small size delta trades in any of these is readily available. You'll have to be a little bit more patient. And like today in gold or silver, the markets are a little bit wider. You're going to have to be a little bit more patient, but definitely doable on any of these scales.
Yeah, it's really just a matter. I think that one of the trades that we sized up earlier today in GC, which would be short I think it was about the 2000 call and then long that 2010 call, that's got to be just a couple of deltas of short exposure in there. And that's all you need. And also it doesn't have to be short options all the time. With this SFX trade, for instance, if you wanted to buy dollars and you went over to 6E and you bought the 55 delta call and sold the 50 delta call, I mean, that's building in those 5 long deltas right there. Same with FXE, doing the same thing there, because short options in ETF markets like this that you would probably be, all right, I need 50 long deltas. I'd probably just sell the at the money put. Those ETF margins are going to be higher and it's going to demand a lot of capital. So I would rather probably go in and build 50 long deltas in FXE with that long call spread. There's a lot of different ways to do it. These are the ratios. You got all the tools at your disposal. And I wanted to just quickly show what you're getting with this. So without any risk reduction via options on gold, you have a $750 move in the last few weeks here in SPRE, which is maybe not a lot for traditional experienced futures traders, but people that, the small exchanges trying to convert to see the advantages of futures, $750 is a good amount for one smalls contract.
Absolutely.
And what you can do here with that short call spread in gold futures or that short call spread in GLD or long put spreads in either of those products is you reduce that $750 move to about a $300 or $400 move here for the month of July, which is really a nice thing to look at, especially moving on to this dollar example here, Pete. You see this dive of about $300 in SFX in the month of July. And by simply adding on July 1st, if you had added just 5 deltas of long exposure in 6E or 50 deltas of long exposure in FXE, this thing is more than halved that down move in the US dollar. And so these simple little hedges, maybe not too simple for everyone, but I think it's worth doing a little bit of learning to get to cross product covered calls or covered puts here, really saving some headache and getting these small futures even smaller.